Now we're going to talk about something about economic indicators. Inflation, unemployment, a gross domestic product. 1. Inflation. Definition. Inflation measures the rate at which the average price level of goods and services in an economy rises over time, eroding purchasing power. In essence, it indicates how much more expensive a fixed basket of goods and services becomes over a specified period, typically a year. Causes of inflation. Demand pull inflation. This occurs when aggregate demand in an economy exceeds aggregate supply, often because of increased consumer spending, government spending, or investment. The higher demand pulls prices upward. Cost push inflation. This type of inflation occurs when the costs of production, wages, raw materials increase, and businesses pass those higher costs on to consumers in the form of higher prices. Built-in inflation. This occurs when wages and prices interact in a cycle. Workers demand higher wages to keep up with rising prices, which in turn causes businesses to raise prices again to cover higher wage costs. Consequences of inflation. Negative effects. High inflation can erode savings, increase uncertainty in business, and reduce the real income of households, especially if wages do not keep pace. Positive effects. Moderate inflation encourages spending and investing. Since people expect prices to rise, they're more likely to buy sooner, and it can help reduce the real burden of debt. Central banks' role. Central banks, like the Federal Reserve in the US or the European Central Bank, ECB in the EU, often target inflation rates, commonly around 2%, to maintain price stability. They use tools such as interest rate adjustments or open market operations to control inflation. 2. Unemployment definition. Unemployment refers to the situation where people who are capable of working, actively seeking work, and willing to work are unable to find employment. It is a vital measure of labor market health and economic performance. Types of unemployment. Frictional unemployment. Temporary unemployment that occurs when people are transitioning between jobs or entering the workforce for the first time. It is often voluntary and reflects normal job turnover. Cyclical unemployment. This type of unemployment is tied to the business cycle. During economic recessions, demand for goods and services decreases, leading to layoffs and increased unemployment. Conversely, it decreases during economic expansions. Structural unemployment arises from a mismatch between the skills of the labor force and the needs of employers. This can be due to technological changes like automation or shifts in the economy, e.g. decline of manufacturing jobs and rise of tech jobs. Seasonal unemployment. This occurs when demand for labor fluctuates according to the time of year, such as in agriculture, tourism, or retail during holidays. Impact of unemployment. Economic impact. High unemployment leads to lower overall demand for goods and services, reduced tax revenues for governments, and higher social security costs. Prolonged unemployment can also lead to a loss of skills and motivation among workers. Social impact. High unemployment rates are often associated with increased poverty, social inequality, and mental health issues, as unemployment can have significant psychological effects on individuals. Natural rate of unemployment. Economists refer to a natural or normal level of unemployment, comprising frictional and structural unemployment, that is always present even in a healthy economy. It's seen as the lowest rate of unemployment that an economy can sustain without causing inflation to rise. Number 3. Gross domestic product, GDP. Definition. GDP measures the total monetary value of all finished goods and services produced within a country's borders in a specific time period. It is one of the most comprehensive measures of a country's overall economic activity and health. Components of GDP. GDP is typically broken down into 4 key components. Consumption, C. Spending by households on goods and services, such as food, healthcare, and entertainment. It usually constitutes the largest portion of GDP. Investment, I. Business investments in capital goods, residential construction, and inventories. This includes spending on equipment and technology that boosts future production. Government spending, G. Total government expenditures on goods and services. This can include spending on infrastructure projects, public services, defense, and education. Net exports, XM, exports minus imports, a positive value, more exports than imports, contributes positively to GDP, while a negative value reduces it. Types of GDP. Nominal GDP measures the value of goods and services at current market prices without adjusting for inflation. it can be misleading when comparing different time periods, as it doesn't account for price changes. Real GDP. Adjusted for inflation, real GDP provides a more accurate reflection of an economy's actual growth in terms of production volume, as it removes the effect of rising prices. Per capita GDP. This divides a country's GDP by its population, giving an average economic output per person. It is often used as an indicator of the standard of living in a country. Importance of GDP. Economic indicator. GDP growth is often seen as a sign of a healthy, expanding economy, while a shrinking GDP signals contraction or recession. Comparison across countries. GDP allows for the comparison of economic performance between countries. However, it's important to note that GDP does not account for inequality, environmental sustainability, or informal economic activities. Limitations of GDP. Non-market activities. GDP doesn't measure non-market activities like household work or volunteer services. Quality of life. It doesn't account for income distribution, environmental degradation, or factors that contribute to human well-being beyond material wealth, such as education, healthcare, and leisure time. Interrelationship between these indicators. These three indicators, inflation, unemployment, and GDP, are closely interconnected. Inflation and unemployment. The Phillips curve suggests an inverse relationship between inflation and unemployment in the short term. Low unemployment often leads to higher wages and higher inflation, while high unemployment tends to keep inflation lower. GDP and unemployment. According to Okun's law, there is a negative relationship between GDP growth and unemployment. When an economy grows, businesses expand, and unemployment tends to decrease. Conversely, during economic downturns, GDP contracts, and unemployment rises. Inflation and GDP. Moderate inflation is often associated with a growing economy. However, excessive inflation can harm economic growth by increasing uncertainty, reducing consumption, and raising the cost of borrowing. Understanding these key economic indicators provides insight into the overall health and trajectory of an economy, influencing policy decisions by governments and central banks.